Tips for investigating in penny stocks. Penny stocks allow traders to make significant gains in a short amount of time. However, it also, in comparison to other options, this is a high-risk option since the trader does not have control of his or her trading capital. These strategies can help you minimize your losses in one of the riskiest investment choices. Penny stocks are named after a penny for a reason. While we all aspire to invest in the next Facebook or Netflix, the reality is that the chances of locating a once-in-a-decade success story are slim. Many of these firms are just getting started and purchased a shell company because it was less expensive than an IPO, or besides, because they do not have a strong business plan. They lack the financial backing to merit investment banker money for an IPO. This doesn't make them a bad investment, but it should make you be realistic about the kind of company that you are investing in. Trading volumes. Look for a high volume of shares being traded on a regular basis. The average volume may be deceptive. If XYZ trades 1 million shares today, and doesn't trade for the rest of the week, the daily average will appear to be 200,000 shares. You'll need steady volume to enter and exit at a reasonable rate of return. Also look at the number of trades per day. Is it one insider selling or buying? Liquidity should be the first thing to look at. If there is no volume, you'll be sitting on dead money, where the only method to sell shares would be to dump at the offer, which will put extra selling pressure on yourself and result in a lower sell price. Is the business capable of turning a profit? It is unusual to observe a startup firm operate in the red, but it's critical to examine why they are doing so. Is it manageable? Will they have to get additional finance, which will reduce the number of your shares, or will they need to form a joint venture in which one firm benefits at the expense of the other? When a firm is profitable, it may use the funds to develop its organization and, as a result, increase shareholder value. However, it's not easy to find these firms. But once you've identified them, the danger of losing your cash and increasing your chances of a much larger return are significantly lower. Have a strategy for both entering and leaving the market. Penny stocks are volatile. They will quickly move up and move down just as quickly. Remember, if you buy a stock at 10 cents and sell it at 12 cents, that represents a 20% return on your investment. A 2-cent decline leaves you with a 20% loss. Many stocks trade in this range on a daily basis. If your investment capital is $10,000, a 20% loss is a $2,000 loss. Do this 5 times and you're out of money. Keep your stop losses close. If you are stopped out, move on to the next opportunity. The market is attempting to communicate with you, and whether you like it or not, it's usually a good idea to pay attention. If your plan was to sell at 12 cents and it jumps to 13 cents, either take the 30% gain, or better still, place your stop at 12 cents. Lock in your gains while avoiding a ceiling on the upside. What is the best resource for learning about the stock? A mailing list is how most individuals discover penny stocks. There are several great penny stock newsletters available, but there are also a lot of pump and dump operations. This lucrative approach has a variety of names, but it's the first step in a long process. It may also be referred to as a pump and dump. The people who profit from this strategy are called pumpers, while those who get caught up in it are known as dummies. Traders buying on the way down. Guess who wins here? Not all newsletters are bad. I have seen my share of unscrupulous companies and promoters. Some are paid in stock, while others are compensated in cash. How to spot the good companies from the bad? Simply subscribe and track the investments. Was there a legitimate opportunity to make money? Do they have a track record of providing subscribers with great opportunities? You'll start to notice quickly if you have subscribed to a good newsletter or not. One other tip I would offer to you is not to invest more than 20% of your overall portfolio in penny stocks. You are investing to make money and preserve capital to fight another battle. If you put too much of your capital at risk, you increase the odds of losing your capital. If that 20% grows, you'll have more than enough money to make a healthy rate of return. Penny stocks are risky to begin with. Why put your money more at risk? Investing in penny stocks is a risky business, but it doesn't have to be. With some careful planning and strategy, you can minimize your risks while maximizing potential gains on the investment. By following these 5 steps. Identifying penny stocks that are profitable with sustainable growth prospects, avoiding penny stock newsletters that promote pump and dump opportunities, investing only 20% of your portfolio's capital into penny stocks at any time. Keeping stop losses close when trading penny stocks, to avoid losing more than 20%, and finally, Always keeping an eye out for new strategies or tips from reputable sources, you'll find yourself heading towards success rather than failure in this volatile market. Until next time, please share, like, and subscribe. You never know who you might help.